If you want to know the secret to like a multi-million-dollar real estate empire, you really don't look at the shiny glass skyscrapers.
Right. No, you definitely don't.
You look at the vacant dirt lot sitting next to the Costco. Or, you look at that suburban strip mall with the mattress firm. Every time you drive down the street, you're probably just seeing the static background of everyday life. But underneath that scenery is this giant invisible chess match.
It really is. It's a massive game.
Exactly. It's a high-stakes landscape of demographic data, hidden lease structures, and incredibly strict tax deadlines that completely shapes our cities. And, well, most of us have no idea it's even happening.
Oh, totally. The people playing this game, they are looking at your neighborhood through a fundamentally different lens. To them, a fast food drive-through isn't about burgers. It's literally a math equation based on the exact number of cars passing by between like 5 and 6 in the evening.
Which is exactly our mission for this deep dive. We are going to decode that hidden landscape for you today. And to do that, we are looking at a highly curated newsletter from Eureka Business Group, or EBG.
Yeah, they're a great source for this.
They really are. They are a retail investment advisory firm based in the Dallas-Fort Worth area. They've been around since 2008, led by their managing principal, Joseph Goslan. And we are specifically looking at their EBG Listings of the Week email. And this is dated May 23, 2026.
And what makes this specific newsletter such a brilliant source for us is that EBG, well, they don't just blast out a list of properties for sale with a price tag.
Right.
They add deep commentary. They include a section for every single property explaining why they like it. So it gives us this incredibly rare window into the actual investment thesis, behind millions of dollars changing hands. We get to see the underlying logic.
So let's unpack this. Because before EBG even gets to the multi-million-dollar properties, they start with a snapshot of the macro market. They set the stage for this specific week in May 2026. And the very first thing Joseph Goslan points out is that, well, not a lot of new properties hit the market this week.
Yeah, and to a casual observer, a drop in inventory like that might look like a huge red flag. You might assume the market is drying up or, sellers are panicking.
Right, exactly.
But the newsletter explicitly tells us this pause was entirely expected. And the reason is, honestly, entirely human.
The reasons are so fascinating. It wasn't some sudden economic crash. It was literally just because most retail brokers were out of town for the annual ICSC conference.
Yep.
And on top of that, there was a holiday weekend coming up, so brokers just collectively decided to hold off on listing anything new.
Which is wild, right? What's fascinating here is that this reveals something critical about the actual mechanics of commercial real estate. We are so conditioned by the stock market to think of investing as purely algorithmic.
Right, just numbers on a screen.
Exactly, moving at the speed of light. But this shows us commercial real estate is still an intensely relationship-driven human industry. A single industry conference and a long weekend can practically freeze new inventory from hitting the market across an entire region.
It's literally a localized pause button.
Yeah.
Just, hey, everyone's out of town grabbing drinks at a hotel bar. Let's just pause the multi-million-dollar deals until Tuesday.
Pretty much.
But okay, there's a tension here too.
Mm-hmm.
Because right before mentioning that pause, the newsletter brings up a video EBG had to create titled, How's the Market? And Joseph Goslan notes this video was prompted by conversations he was having with lenders,
Right.
which then caused his clients to flood his inbox asking what was going on. So I'm a bit confused by the chain reaction here. Why are private conversations with lenders the ultimate trigger for buyers and sellers getting so anxious about the market?
Well, it's because lenders control the absolute lifeblood of commercial real estate, which is capital flow. When you or I buy a house, we get a 30-year fixed mortgage, and we don't really think about the bank ever again. Commercial real estate doesn't work like that. These are complex, multi-million-dollar commercial loans. They often have shorter terms, variable rates, or strict performance covenants. The entire system relies on debt.
Okay, so if the lenders tighten the faucet, everyone goes thirsty.
The ripple effect is basically instantaneous. If lenders start shifting their terms behind closed doors, maybe they're demanding more cash down or they are getting nervous about retail spaces, the math on every single potential deal changes overnight.
Oh, wow.
Yeah, and the clients reaching out to EBG, they understand this reality. They know that whatever the banks are whispering today is going to dictate property prices tomorrow. So EBG had to put out that video to reassure their clients and keep them ahead of that capital flow.
Okay, so we have a market that is momentarily paused by a conference, but clearly buzzing with underlying anxiety about lending. With that context set, I want to look at the actual properties that did make the cut this week.
Let's do it.
EBG break these down by price tiers. And rather than just reading down the list, I want to look at the massive shift in strategy as we move up the ladder. Let's start at the ground floor, the under $3 million tier.
Yeah, the entry-level tier. This is often where you see the most creative hustle. Buyers at this level are looking for, unique angles that institutional money might just ignore.
We see that hustle immediately. Let's look at a property in Fort Worth, Texas. It's a 4,700 square foot retail space, and the tenant is my eye doctor.
Okay.
EBG lists some very specific bullet points here. It sits in a medical corridor with a $165,000 one-mile income. The tenant has over 800 locations, and it operates on an NNN lease structure with annual rent increases.
Let's pause on that jargon for a second. What exactly is an NNN lease, and why is EBG highlighting it?
So NNN stands for triple net, and it's basically the holy grail for a passive investor. Because think about a standard residential lease. If the roof leaks or the property taxes go up, the landlord pays for it out of their own pocket.
Right, the landlord handles the headaches. Exactly. But in a triple net commercial lease, the tenant is on the hook for practically everything. The tenant pays the property taxes, the building insurance, and the maintenance costs.
Wait, really? So as the owner, you basically just check your mailbox for the rent check and do nothing else?
Yep. It functions a lot more like a corporate bond than a piece of real estate. You have an 800-location medical tenant guaranteeing the rent, handling the maintenance, and agreeing to annual rent increases. So you are buying absolute sleep-at-night stability.
Okay, but then you contrast that stability with another property in this exact same tier. It's a 2,900 square foot space in McKinney, Texas, currently operating as a gym.
Right.
EDG's Why We Like It section here is completely different. They point out it's 2 combined units, so you can lease part or all of it. It's selling below the county assessed value. And, crucial detail here, owner financing available. This feels like the exact opposite of a passive bond.
It is the exact opposite. The McKinney Gym property is for someone who wants to really roll up their sleeves and force the property to be worth more. Owner financing available is a massive lever.
How so?
Well, remember how we just talked about lenders getting tight with capital?
Yeah.
If the current owner is willing to act as the bank and finance the purchase for you, you can bypass traditional lenders entirely. You can negotiate the down payment and the interest rate directly with the seller.
Oh, that makes total sense.
Yeah.
And buying it below the county assessed value means you are essentially walking into immediate equity on day one.
Exactly. The strategy here is flexibility. You buy it creatively, you have the option to split the units to collect 2 rent checks instead of 1, and you build value through active management.
Speaking of active hustle, let's talk about the land deals in this starter tier.
Yeah.
Because this is where the raw data really comes into play. EBG highlights a 2.7-acre commercial dirt lot in Balch Springs, Texas.
Dirt lots are fascinating.
Yeah, and the main selling point here isn't a building, it's traffic. They specifically note 24,094 VPD frontage, VPD being vehicles per day. And they pitch this dirt as having QSR potential, which is quick service restaurant, fast food.
Right. Think about the fast food place you stopped at on your last road trip. You probably pulled in just because you were hungry and it was right off the exit.
Sure.
But that franchisee didn't buy that specific patch of dirt by accident. They bought it because a data sheet told them exactly 24,094 cars would pass by their sign every single day.
They know exactly what percentage of those 24,000 cars will subconsciously crave some fries and, pull into the drive-thru. They're literally monetizing the eyeballs driving past the grass.
That's it, exactly. The entire fast food business model relies on hyperlocal traffic metrics. At this entry-level tier, you aren't buying architecture. You are buying access to a highly specific stream of commuters.
That's wild. But my favorite listing in this tier is the land in Cedar Hill, Texas. Almost 38 acres of residential land. EBG notes it's a CHISD asset sale and a sealed bid opportunity. CHISD stands for Cedar Hill Independent School District. So the school district is selling off surplus land, and they are doing it via a sealed bid.
And this introduces a really fascinating psychological element to the investment. A sealed bid isn't an open auction where you can see the guy across the room raising his paddle.
Right. It's a high-stakes blind guess.
Completely blind.
You only get one shot to write a number on a piece of paper. You have to figure out what that 38 acres is worth to you. But more importantly, you have to guess what it's worth to every other developer in the county. If you bid $5 million and the next closest guy bid $3 million, you just overpaid by $2 million.
Yeah. And the variance in those bids can be wild, which means there is massive opportunity to steal a property if you understand the local zoning better than your competitors.
Like,
Well, EBG notes this land is zoned residential with BTR possible. BTR means build to rent. These are entire neighborhoods of single-family homes built specifically to be rented out by a single corporate landlord.
oh, wow.
So if you are the only bidder who knows how to execute a build-to-rent strategy on that specific site, your internal valuation of the dirt is going to be completely different from a guy who just wants to build standard houses.
Okay, so we've seen the scrappy hustle of the under $3 million tier. Now let's pivot to the middle tier properties ranging from $3 million to $7 million.
This is a big jump.
It is. The strategies completely diverge here. We move away from the blind auctions and owner financing, and instead we see this incredible tug of war between locked-in defense and raw, calculated speculation.
Yeah, because the capital requirements are higher, so the risk profiles become much more polarized. Investors really have to decide exactly what game they want to play.
Let's look at the defensive game first. In Corpus Christi, Texas, EBG lists a nearly 15,000 square foot single-tenant retail space. It's brand new construction, built in 2024. The tenant is WellMed, which EBG points out is a United Health subsidiary.
Right.
There are 8.75 years remaining on the lease with built-in rent increases.
I mean, corporate backing from a massive healthcare giant, nearly a decade of guaranteed rent, and a building so new the roof won't need replacing for 20 years. That is the ultimate defensive posture. You buy that property to park your wealth safely.
And they have another one just like it in Allen, Texas. A 10,000 square foot retail center. Built in 2020 and in lease terms, exposure to 55,000 vehicles per day, and it's 100% leased.
Super solid.
Right. So Corpus Christi and Allen are aggressively bragging about having long leases and being completely full. That makes total sense to me. But here is where I get genuinely confused. In that exact same 3 to 7 million tier, there is an industrial flex space in Roanoke, Texas. It's almost 17,000 square feet outside the city limits. And under their Why We Like It section, EBG specifically lists short-term leases.
Yep.
If I'm dropping $4 or $5 million on a warehouse, I want the tenant chained to the radiator for the next decade. Why on earth would an investor want a tenant whose lease is about to expire?
It sounds like financial self-sabotage if you are operating with that Corpus Christi mindset. But EBG writes this exact phrase in the newsletter. Short-term leases offer value add or owner-user opportunity. To understand this, we really have to look at the nuts and bolts of how commercial real estate is actually valued.
Okay, lay the math on me.
So the value of a commercial property is primarily dictated by its net operating income, or NOI. Basically, how much cash does the building throw off after expenses? If you buy a building with a 10-year lease in place, you are completely locked into that income stream. You can't raise the rent, which means you can't significantly raise the value of the building. But if you buy a building with a lease ending in 6 months, you hold the ultimate value add lever.
Because you can kick them out.
Exactly. You can choose not to renew their lease, go in, slap some fresh paint on the walls, upgrade the lighting, and sign a brand new tenant at a dramatically higher current market rate.
Wow. Okay.
Let's say you increase the net operating income by $50,000 a year. Because commercial properties are valued on a multiple of their income, which is called a cap rate, that $50,000 increase in rent might instantly increase the resale value of the building by $600,000 or $700,000. You force the appreciation.
So you aren't buying the current income. You're buying the flexibility to legally manipulate the income.
Exactly. And the other side of that flexibility is the owner-user aspect EBG mentions. Let's say you own a rapidly growing plumbing business, and you need a massive warehouse to store your trucks and inventory. You want to buy a building and move your operations into it next month. You physically cannot do that if United Health has the space locked up for 9 years. You actively hunt for buildings with expiring short-term leases so you can occupy the real estate yourself.
The speculation gets even wilder when we look at the McKinney land listing in this tier. Over 6 acres of commercial land. It has Highway 380 frontage, which is a massive artery in North Texas.
Huge!
But the key bullets EBG uses to sell it are McKinney ETJ, no zoning restrictions, and near airport expansion. What does ETJ actually mean, and why is it such a selling point?
ETJ stands for extraterritorial jurisdiction. It basically means the property is sitting just barely outside the official city limits of McKinney.
So you don't have to deal with the city council.
Exactly. The municipal red tape practically vanishes, When EBG says no zoning restrictions, they are handing a developer a massive blank slate. Inside the city, you might spend 2 years and hundreds of thousands of dollars fighting the city council just to get permission to build a storage facility instead of an office park. In an ETJ, the friction is gone. Add in the fact that it's near an expanding airport, and you aren't just buying a patch of dirt, you are buying the speculative future layout of an entire economic corridor before the city grows out to swallow it.
Wow. So the middle tier is really a gut check on your risk appetite. Do you want the sleep-at-night corporate guarantee, or do you want the blank slate and the short-term leases so you can force the value up yourself?
It really is. And that leads us directly into how the truly massive players operate.
Right. Let's elevate to the heavy hitters, the $7 million plus tier. At this scale, it's no longer just about individual hustle or forcing a single tenant's rent up. It feels like everything relies on massive demographic gravity and corporate anchors.
Yeah, the entire ecosystem of the deal changes here. You are often dealing with institutional money, real estate investment trusts, or massive private syndications.
Let's look at a prime example in Heath, Texas. It's an almost 14,000 square foot retail center, brand new 2022 construction, 100% leased. The demographics are staggering EBG notes, a $246,000 1-mile income. But the bullet point that jumps out is Tom Thumb shadow anchor.
Oh, the shadow anchor. That strategy is one of the most reliable plays in commercial real estate.
I look at this and the Katy, Texas listing. Katy is an 8,500 square foot single-tenant building occupied by Fogo de Chao, a high-end steakhouse. It has almost 14 years left on a long-term NNN lease, a corporate guarantee, and sits in an area with a population over 300,000 within 5 miles.
Huge numbers.
Right. But the crucial detail EBG highlights, adjacent to Costco.
Yeah, shadow anchor and adjacent to two phrases that dictate millions of dollars in value.
It reminds me of those little remora fish that swim attached to the belly of a shark.
That is exactly it.
These smaller retail properties, well, smaller relative to a massive grocery store or a Costco warehouse, they are incredibly valuable specifically because they feed off the massive habitual foot traffic generated by the giants next door. Yeah. You don't have to spend a dime on marketing to be a destination if you're sitting in the parking lot of the destination.
The remora fish is the perfect metaphor. The shadow anchor, the Costco, or the Tom Thumb grocery store, they don't own your building. They don't pay you rent.
Right.
But their mere existence guarantees that thousands of affluent cars will turn into your shared intersection every single day, whether it's for a weekly grocery run or buying in bulk. If you own the strip mall next door, your tenants, like a hair salon or a specialized restaurant, they survive entirely on that spillover. You are making a highly calculated bet on a multi-billion-dollar corporation's ability to draw a crowd.
Hold on, though. I wanted to test this logic against the Edmond, Oklahoma property because this one breaks my brain a little bit.
Let's hear it.
It's massive. A 160,000 square foot retail center sitting at an intersection with over 66,000 vehicles per day. And it actually has its own anchors inside the building, TJ Maxx and Home Goods.
Which is a fantastic, highly resilient tenant mix.
Sure. But the listing boasts two things under the highlights: lease up upside and below market rents. Are they seriously bragging that they are terrible at collecting rent? Why would I want to buy a massive shopping center that is actively undercharging its tenants?
Okay, so it's the exact same math we talked about with the short-term leases in Roanoke, but deployed on a massive institutional scale. To a heavy hitter investor with a $50 million fund, below market rents is the ultimate neon sign. It means the previous owner got lazy and left millions of dollars on the table.
So they are basically advertising their own inefficiency as a feature for the next guy.
They have to, because that inefficiency is the only reason a big player will buy it. Let's run the math again. If the current owner in Edmond has tenants paying $15 a square foot, but the market average for a TJ Maxx anchored center in that zip code is actually $25 a square foot, a new buyer sees massive instant equity.
Wow.
They buy the property, wait for those underpriced leases to expire, and hike the rents up to the market rate. Over 160,000 square feet, raising the rent by just $10 a foot generates an extra $1.6 million in net income every single year.
That is staggering.
And because of the cap rate multiplier, that $1.6 million increase in income might increase the resale value of the entire shopping center by $20 or $30 million.
That's just wild.
And lease-up upside simply means there are physically empty storefronts in the center. Every time you fill an empty space with a paying tenant, you add more income, which exponentially adds more value to the asset.
You see that focus on stability and service in the Plano, Texas listing as well. Over 19,000 square feet, 93% leased, sitting in a dense infill location. EBG specifically highlights it has a mattress firm anchor and service-oriented tenancy.
Yeah, service-oriented tenancy is basically the modern defense mechanism against e-commerce. You can buy a book on Amazon, but you can't get a haircut, a dental cleaning, or a physical therapy session over the internet.
Exactly.
Investors flock to tenants providing physical services because they are insulated from digital disruption.
So what does this all mean for you, the listener? We've looked at the scrappy blind auctions, the math of forcing appreciation, and the demographic gravity of Costco. But to tie this entire hidden landscape together, EBG reveals how these investors actually execute these massive transitions without losing their shirts to the IRS.
The tax part is crucial.
In the newsletter, EBG includes a section for their 1031 exchange timeline calculator.
This is the hidden engine room behind almost every major transaction we've discussed today.
They include a bold warning right above the calculator, don't miss critical deadlines. And in their About Us section, EBG pitches themselves by saying they advise on 131-driven replacement needs. Their core philosophy is listed as, not every opportunity is the right opportunity. Work with an advisor who knows the difference.
Right.
Why the intense panicked focus on a ticking clock? Why are there critical deadlines just to buy a building?
Because commercial real estate isn't just about finding a good location. It is largely about navigating the United States tax code. A 1031 exchange is a specific provision in the tax code that allows an investor to sell a property and completely defer paying capital gains taxes on their massive profits if they reinvest that money into a new, like-kind property.
It sounds like a game of high-stakes financial hot potato. The IRS hands you a burning millions of dollars coal, and you have to toss it into a new property before it burns your hands.
That is an incredibly accurate way to describe it, because the IRS does not let you hold that money forever. A 1031 exchange comes with ruthless, government-mandated deadlines. Once you sell your initial property, you have exactly 45 days to formally identify the replacement property you want to buy.
Wow.
And you have exactly 180 days to close the deal.
Wait. You have 45 days to find a multi-million-dollar shopping center, ensure the math works, check the zoning, verify the shadow anchors, and commit to buying it.
Yes. And the IRS does not care if you get sick or if the bank delays the paperwork or if the seller backs out. If you miss that 45-day window on the EBG calculator by a single minute, the entire exchange fails.
It is so stressful.
It is, because suddenly that great property you sold last month triggers a catastrophic tax event. You instantly owe the government hundreds of thousands or millions of dollars in capital gains taxes.
Which perfectly explains why EBG positions themselves as advisors, not just guys who unlock the front door to show you a building. If I have a 45-day ticking clock over my head to place $5 million, I don't have time to make a mistake on a Roanoke warehouse with bad zoning or an Edmond property where the rents can't actually be raised.
Right, the pressure makes people sloppy.
Okay.
When investors are rushing to place capital to beat a tax deadline, they often talk themselves into buying bad real estate just to save the tax money.
That makes total sense.
EBG emphasizes that they understand how retail assets actually perform because they are trying to protect their clients from buying the wrong opportunity out of pure desperation. They dive into the lease level review and the operating exposure to ensure the math actually holds up.
This has been such a fascinating re-education on how the world around us is built. We started by seeing how a single broker conference can literally hit the pause button on regional inventory. We dug into the hyperlocal math of drive thrusts and the scrappy value-add potential of forcing short-term leases higher.
So many moving parts.
Right. We saw the demographic gravity of being a Remora next to a Costco, and finally we uncovered the ticking clock of the 1031 exchange that is forcing so many of these massive purchases behind the scenes.
And, I hope this leaves you with something to genuinely mull over. The next time you are running errands and you drive past a seemingly boring strip mall, a mattress firm, or even a vacant patch of weeds sitting next to a highway off-ramp, realize you aren't just looking at bricks or grass.
Yeah.
You are looking at a highly calculated multi-million-dollar bet. A bet on traffic patterns, demographic shifts, cap rate math, and ticking tax deadlines. It completely changes how you view the physical reality of your own neighborhood.
It's all an invisible chess match playing out right in front of us.
Yeah.
And now you know how to see the board. Thank you so much for joining us on this deep dive. Catch you next time.